I know it's nice to finally be able to talk about some data. So I think it should be a sort of soft-ish print. We're looking for 0.26 on core. Certainly a lot different than what we expected a couple months ago, right? There was an expectation that the tariffs would be a meaningful impact on tariffs and on inflation, and it's been a lot more modest. So our expectation is the next couple months it should be kind of slowish. In Q1, I'm a little more nervous just because inflation in Q1 tends to be a problem, and now you have a lot more added headwinds from that perspective.
So to the extent we're not seeing it at the consumer level, does that mean that companies are taking it in their margin, maybe a little bit more than maybe we anticipated?
I think a little more than anticipated. I think it's just getting distributed across the supply chain in such a way that it's not that detrimental for anybody at this point. And I think that might continue to be the case, and then slowly it will be passed on to the consumer over a period of months, which is a lot easier for the consumer to absorb.
How is the consumer? It seems like I'm hearing more and more about the K-shaped kind of consumer out there because the high end doing really well. We saw some good luxury numbers out of LVMH and Hermes, and it seems like the consumer is doing fine until you see stories where the consumer is really not doing fine.
Yeah, it's a tale of haves and have-nots, and the group of haves is a lot bigger than the have-nots. So it's been a large part of the economy has performed fairly well, largely because people are still employed, even though the labor market has been a lot less dynamic than it typically is. It's been okay, and most people are still employed, and they're making decent wage growth. On top of that, you've had equity net worth has been tremendous, and it's not just about the top income earners who are invested here. It's been a lot broader than it typically is the case.
Okay,
you even have younger investors.
Thank you for bringing this up. Jason Furman had a brilliant tweet on this, I'm going to say 10 days ago. Go back to the textbook and tell me about, quote, the wealth effect.
Yeah, so, and what typically is the case is academic studies, have studied this for years, and they would tell you it's for every dollar of equity wealth that people have gained, people spend about 2 to 3 cents on average, which is small. However, we've had over $6 trillion worth of equity gains this year, so that amounts to something that's actually kind of substantial, in which case it could have boosted growth by 0.4%.
Can you do that math in your head?
No. I got my HP here, but...
Stephanie Roth's using scientific notation again.
Yes.
Continue.
Talk about a boost to the economy of about 0.4%. So if GDP should have...
0.4 GDP.
Exactly, and that's one reason why the consumer is running fairly strong here.
Given that backdrop here, how do you think our Fed's going to behave over the coming 3, 4, 5 meetings coming up?
Yeah, so the next meeting, they don't really have that much information. They're almost certainly to cut. Beyond that, I think it becomes a more interesting question, and I think it's really notable that Governor Waller has been out recently saying, of course, October's a certainty, but then beyond that, it's going to become more data dependent, and he's been one of the more dovish members of the Fed recently.
Okay.
So I think they'll cut a couple more times, but perhaps not consecutively as the market's anticipating. And then we'll get to some point next year where it's going to be a real question whether the Fed can cut further.